Jake buys a rental property. Marcus puts the same money into index funds. They both think they made the smarter choice. They're both wrong because one of them forgot to count the hours and the other forgot to count the zeros. And when you actually run the numbers over 20 years, the gap will make your stomach drop. I'm Sebastian. This is Canadian Finance, education, not advice. Let's get into it. Let's keep this fair. Jake and Marcus both have $50,000 saved. They both earn $75,000 a year, which puts them right around the Canadian median. They're the same age, same city, same financial starting point. The only difference is what they do with that 50 grand. Jake uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood somewhere in Ontario outside the GTA. He takes out a 25-year mortgage at 5.5% interest. His monthly mortgage payment is about $1,500. He finds a tenant willing to pay $2,000 a month in rent. On paper, that's $500 a month in profit before he spent a single dollar on anything else. Jake feels like a genius. Marcus takes the same $50,000 and drops it into XEQT, a total market index ETF that holds thousands of companies globally at 0.17% in fees, no leverage, no tenants, no keys to hand over. He sets up an automatic contribution of $300 a month and doesn't think about it again. His coworkers ask him what he's investing in. He says index funds. They nod politely and change the subject. Nobody's impressed. On day one, Jake has a house, a tenant, and a story to tell at the Tim Hortons drive-thru. Marcus has a Wealthsimple account and a confirmation email. It's not even close in terms of how it feels. But feelings and math are two very different things. For the first few years, Jake is living the landlord dream. Rent checks hit his account on the first of every month. He drives past his property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving a couple thousand off his tax bill each year. He's building equity with every mortgage payment. He's watching comparable homes in the neighborhood tick up in value. Everything about this investment feels real, tangible, and smart. Marcus logs into his Wealthsimple account once a quarter. The number goes up a little, then down a little, then up a little more. Year one, his $50,000 grows to about $55,000. Year two, maybe $61,000. It doesn't feel like anything is happening. There's no key in his pocket, no tenant texting him, no asset he can point to from his car window, just a number on a screen. Jake's friends ask him about the property. Marcus's friends don't ask him about anything. The social proof alone makes Jake feel like he's winning by a mile. Now let's look at the actual numbers through year three. Jake has collected roughly $72,000 in rent. His mortgage payments total about $54,000. That leaves $18,000 in gross cash flow. Sounds great until you subtract everything else. Property taxes in Ontario run about $3,500 a year. Insurance adds another $1,800. He's already replaced a water heater for $1,200, fixed a leaking roof for $3,200, and dealt with 1 month of vacancy between tenants that cost him $2,000 in lost rent, plus $700 to clean and relist. Property management. Jake does it himself to save money, but that means phone calls at 10 at night, weekend showings, and coordinating repairs on his lunch break. After all real costs, Jake's actual net cash flow over 3 years is somewhere around $2,000 to $4,000, not the $18,000 that looked so good on a napkin. And that doesn't account for a single hour of his time. Marcus, meanwhile, has put in $50,000 plus $10,800 in monthly contributions at roughly 10% average annual return. His portfolio is sitting at about $76,000. He spent 0 hours managing it, 0 phone calls, 0 emergencies. But Jake still has leverage working for him. His $250,000 property has appreciated maybe 3 to 4% a year and is now worth around $270,000 to $280,000. His equity, the difference between what the house is worth and what he owes, has grown to roughly $55,000 to $65,000. That's real wealth. And it came partly from using the bank's money. That's the power of leverage. And it's the one advantage index fund investors can't easily replicate. The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meetup, The number your landlord buddy brags about at the barbecue. What nobody talks about is everything that comes out of that rent check before you actually keep any of it. Vacancy. The average rental property in Canada sits empty about 1 month per year. That's not a disaster, but it's a full mortgage payment with zero income to cover it. And when a tenant leaves, you're paying for cleaning, minor repairs, listing fees, and your own time to screen and show. Maintenance and repairs. The general rule is to budget 1 to 2% of the property's value per year. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $200 faucet fix. Other years it's a $7,000 HVAC replacement you didn't see coming and can't postpone because it's February in Ontario and your tenant is threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are guaranteed future costs and they come in chunks of $5,000 to $15,000. If you're not setting aside money every month for these, you're not running a business. You're running on luck. Property management. If Jake hires a manager, that's 8 to 10% of monthly rent gone immediately, roughly $160 to $200 a month. If he manages it himself, he's working a part-time job he's not getting paid for. Either way, it costs something. And then there's the one risk nobody in Canada likes to discuss. A tenant who stops paying and knows the landlord and tenant board process can cost you 3 to 6 months of lost rent plus legal fees. In Ontario especially, this isn't theoretical. That single event can erase an entire year's profit or more. None of this shows up in the $500 a month cash flow number, but it shows up eventually. By year 5, Jake is deep in the reality of being a landlord. He's on his third tenant. He's replaced the roof for $9,000, dealt with a plumbing emergency that cost $1,600, and spent 1 month with the property empty between tenants. He's raised rent to $2,200, which helps, but his property taxes and insurance have gone up too. His actual cash-on-cash return, the money he pockets relative to the money he put in, is hovering around 3 to 5% after all real expenses. Not bad, but not the 15 to 20% return he told his friends about at the barbecue. Marcus is still doing absolutely nothing. His portfolio has grown from $50,000 to roughly $135,000 to $150,000 by year 7, including his $300 monthly contributions. He didn't pick stocks, he didn't time the market, he didn't do anything except not touch it. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions. Compounding is boring for the first 5 years and astonishing for the next 15. By year 10, Jake's property is worth roughly $335,000 to $350,000. His remaining mortgage balance is about $155,000. That puts his equity at approximately $180,000 to $195,000. Over 10 years after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Jake's total out-of-pocket beyond the original down payment is somewhere between $20,000 and $35,000. Marcus's portfolio with consistent $300 monthly contributions and roughly 10% average annual returns is sitting at approximately $165,000 to $18,000. He put in $50,000 upfront plus $36,000 in contributions, $86,000 total. The rest is pure compound growth. And he spent exactly 0 weekends fixing anything. At year 10, they're surprisingly close in total wealth. Jake might be slightly ahead thanks to leverage, but Jake also spent hundreds of hours managing his property, took on hundreds of thousands in debt, and concentrated his entire investment in a single asset in a single postal code. Marcus diversified across thousands of companies worldwide and never lost a night of sleep. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or nearly there. His equity is somewhere between $400,000 and $500,000 depending on appreciation. He's been collecting rent the entire time, but after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow might be $40,000 to $80,000 above what he spent, maybe more in a hot market, maybe less in a flat one. Marcus's portfolio at 10% average annual return with $300 monthly contributions. His original $50,000 has grown to approximately $420,000 to $460,000. That's with total contributions of $122,000 over 20 years. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 in the morning phone calls about a burst pipe in January. When you compare net worth, they're in the same ballpark, somewhere between $400,000 and $500,000 each. But how they got there is completely different. Jake worked for his. Marcus waited for his. Jake had stress, risk concentration, and illiquidity. Marcus had volatility, but liquidity and freedom. And here's the part that changes the math dramatically. If Marcus increased his monthly contribution by even $200, bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. Because in the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. Now, if I only showed you the downsides of real estate, I'd be doing exactly what every stock market influencer does, and that would be dishonest. Index funds have real risks that people love to gloss over. Volatility is brutal. In 2008, the TSX dropped roughly 35%. In March 2020, it dropped 37% in 5 weeks. If Marcus had $150,000 in his portfolio and watched it fall to $94,000 in a month, that's not a number on a screen. That's gut-wrenching, and the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. There's no cash flow. Unlike a rental property, index funds don't send you a monthly check you can spend. Dividends exist, but on a total market fund, you're looking at maybe 1.5 to 2% yield. On $150,000, that's about $200 a month. That's not replacing anyone's income. No leverage. Marcus used $50,000 to control $50,000 in assets. Jake used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when property values rise, and it's the main reason real estate creates more millionaires than the stock market in most surveys. And there's no depreciation deduction. Canadian real estate investors can deduct the theoretical decline in their building's value from their taxable income, even while the property is actually appreciating. That's a legal tax shelter that index fund investors simply don't have access to outside of registered accounts. Real estate wins in specific identifiable situations in Canada. If you're in a market where the rent-to-price ratio is strong, meaning monthly rent is at least 4.8 to 1% of the purchase price, the cash flow math works in your favor from day one. These markets exist in Canada, they're just not Toronto or Vancouver. If you're willing to treat it as a business, not a side hustle, screening tenants carefully, budgeting for capital expenditures, building systems, understanding the Residential Tenancies Act in your province, the returns can exceed index funds, especially with leverage. If you use house hacking, living in one unit and renting the others, you can reduce your own housing costs to near zero while building equity. That's something XEQT simply cannot do. And if you understand strategies like capital cost allowance and how to structure your holding, you can grow your real estate portfolio in ways that stock investors can't replicate without registered accounts. Real estate isn't a bad investment, it's a misunderstood one. Jake and Marcus both walked away from that decision thinking they were making the smart play. Jake thought real estate was the proven path to wealth. Marcus thought the stock market would do the work for him. Neither of them actually sat down and mapped out what this costs in dollars, in time, in stress, and in risk. Over 10 or 20 years, the real trap isn't real estate, and it isn't index funds. The real trap is picking either one based on a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving without ever running the full numbers for your own situation. And if you're wondering what happens when you do both, when you own property and invest in the market at the same time, the math changes everything you think you know. That's a video for another week. But for now, the next time someone tells you real estate always wins or index funds always win, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this made you think differently, hit subscribe and turn on notifications. Every week, I break down the financial decisions that actually matter for Canadians. Drop a comment. Are you Team Jake or Team Marcus? And drop your province, because this math plays out very differently in Ontario versus Alberta versus BC. I want to know where you're at. I'm Sebastian, this is Canadian Finance, and I'll see you in the next one.